Hello, I'm Steve Buser, Professor Emeritus of Finance at the Fisher College of Business at The Ohio State University. I welcome you to the third in a series of sessions on the state of the U.S. economy. We pick up where we left off for the last session, and that is by discussing both direct and indirect effects of the collapse in the housing bubble and the impacts on the U.S. economy, in particular, the impacts on the financial strength of the U.S. economy. For many home builders, construction projects had to be scaled back, delayed, or canceled entirely when the housing bubble collapsed and the demand for their product ended. Homeowners, including many investors who had made purchases in the hope of a quick resale at a profit, also suffered in terms of values of their investments. Indeed, for many families, their equity investments in housing was their largest single investment. Economists estimate that the combined value of the losses on home equity has been on the order of $3 trillion and continues to grow. In response to the loss of wealth and the loss of access to home equity borrowings, many households were forced to cut back on routine spending. This contributed to a downward spiral of lost sales, reduced production, lost jobs, and so on. As previously noted, dramatic cuts in new home construction added to the downward spiral in economic activity. In addition to traditional wealth effect, many families had been tapping into home equity value of their homes in the form of home equity lines of credit. Available credit under such loans dried up as home values declined. For many families, the decline in home values exceeded the amount of equity they had in their homes. That left them in an inverted or short condition in which the value of what they still owed in the form of their mortgage exceeded the value of their home. This prompted a wave of mortgage defaults in which homeowners effectively sold their homes back to banks that had made them first mortgages and/or second mortgages on their homes. Additional defaults occurred when one or more members of households started to lose jobs by virtue of the general decline in activity. And thus we've had a snowball effect. Both the general level of financial problems and the complexity of those problems were greatly enhanced by what had become a relatively routine practice on the part of mortgage lenders, namely to make mortgages, but to only retain the servicing contract, meaning that they would continue to collect payments from the borrower, but they would not hold the mortgage. They would sell that mortgage to a third party. The third party might very well bundle one mortgage with many other mortgages and then sell claims to yet other investors. As a result, it was increasingly difficult to track even who owned which mortgages, much less which mortgages were in trouble and who were the ultimate investors in those troubled mortgages. As a result of such standard practices, we had what we call a lack of transparency, that we could not literally see who owned what. Wall Street developed and aggressively marketed these products to investors, and they also added yet another dimension. They would offer insurance or contracts which would guarantee payment of certain payments if you owned mortgages. But yet the issuer of that contract bore substantial risk. When it was ultimately determined that several major institutions had suffered massive losses in such derivative mortgage-backed securities, it sent a shockwave through the entire mortgage-backed financial community. For example, AIG, which had been a highly regarded insurance institution and was not even known to be in any way involved in mortgages, finally revealed that it had massive losses in mortgage-backed securities that ultimately risked the very survival of that institution. The government had to put together a massive bailout program of $85 billion, or about 3 times the level of the bailout they've been applying to typical banks. And this was for an institution that had no obvious link to the mortgage operation. So if AIG and a growing number of other firms with no obvious link to mortgages had gotten into financial trouble, one can only wonder where the rest of the world might be and who else might be exposed. And that's the topic that will continue on the next segment.